The Reserve Bank has sprung a hawkish surprise in its June policy. Yes, the interest rate and the stance has been left unchanged as expected by the CNBC-TV18 poll and the Citizens Monetary Policy Committee. But the nuances are hawkish. The CPI forecast, inflation forecast for FY24, it was expected to be cut to below 5%, maybe 4.8 or 4.9 from the previous 5.2, has been cut only 10 basis points to 5.1. Also, the governor repeatedly insisted that the MPC's mandate was not to get CPI to the tolerance band of 4 to 6%, but to align it to the target of 4%. Let's first hear out the governor.
Given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4% going forward.
Post-policy, the 10-year bond yield rose a bit, ended over 7% from the overnight close of 6.98, went to 7.02. But in the swap market, the yields moved much more as hopes of an early cut clearly vanished. Now it's getting pushed on to April, at least in the swap market. To understand more about what the policy means and for their thoughts on the state of the economy, I have with me perhaps the best brains trust of the market, Dinesh, Khara, Chairman of State Bank of India, B. Prasanna, Head of Global Markets Group at ICICI Bank, Mridul Saggar, former member of the Monetary Policy Committee and former Executive Director at Reserve Bank, Samiran Chakraborty, Chief Economist for India at Citi. Gentlemen, thank you very much for joining me. Mr. Khara, would you agree this is a slightly hawkish surprise?
Well, I think the way I look at it is, yes, of course, stance is something, and also the expectation in terms of inflation. What you mentioned that we were expecting much lower expectation of inflation. Well, if you evaluate on those terms, yes, perhaps yes. But
okay.
The fact of the matter is that there are various uncertainties which are still there in the system. That is why perhaps this kind of a announcement has come from RBI.
Okay.
That's why.
Okay. All right. Well, Samiran, the expectation, at least in the stock market, was a bit cheerful that growth could be, forecast a little higher and inflation would be forecast a little lower. That combo would have been great for definitely the stock markets, maybe a little less so for the bond markets. What's your sense? The RBI is way more cautious about inflation and also about growth, you think?
I think the growth estimates are quite realistic. The inflation forecast, in our view, RBI is slightly more conservative at this time because there is this uncertainty around weather-related shocks over the next couple of months. So since RBI has waited for so long to get inflation down to its medium-term target, at this juncture, they would probably want to see through these weather-related shocks. And also the recent significant decline in momentum in core inflation, we don't think RBI has factored that in for a longer period. They probably think that momentum would come back in latter part of the year. That's why probably the governor has very clearly mentioned that there are still price pressures in second half. Whatever adjustments to the forecast that they have made is only for the first half, which is more of a mark-to-market nature. And the last point is that I don't think they are building in any sort of a reduction in fuel prices in the current forecast, but we know that that's one possibility that could emerge in the latter part, and to that extent, there could be some downside surprises to inflation as well.
Okay. Since someone has already worn the MPC's, the official MPC's hat, you are our Citizens MPC member, but the official former MPC member is also with us. Mridul, what do you think is going behind this kind of an inflation forecast? Clearly way above what the street was expecting the RBI to do. They've just brought down the Q1 from 5.1 to 4.6 and distributed it over 4 quarters for the full year and brought it down by 10 basis points, not factoring in a momentum of lower inflation. What do you believe is the thinking? behind this?
I think it's a typical conservative central bank attitude. So as I have typically said, that there is a downside to the RBI's inflation numbers. Now, having said that, let me clarify one or two things. Firstly, they brought down the inflation forecast from 5.2% in April to 5.1%, but they also means that 10 to 12 basis point, which is not factored in on account of the MSP hikes, the target goes back to 5.2 for all practical purposes. Now, if it is on normal monsoon assumption, which is part of the statement, then there is a downside to it. But I think this year the weather disturbances through El Nino and probably late monsoons and climatic changes can cause a havoc. So there is a cushion in RBI forecast, and that's important to understand, that the cushion could come pretty handy. Only thing is, this under the normal monsoon assumption, this assumption may not hold.
Okay. No, my assumption, yeah, maybe it was a cushion given because of the weather, but chances are they just don't want to sound dovish. And maybe that's why a wanton overestimation of the inflation, or conservative estimate of the inflation. Prasanna, now the more material question for you and for Mr. Khara would be, when do they cut?
So I think, Latha, I was actually hoping that even though the expectations of a change in the stance was actually getting priced out in the last 1 or 2 weeks because of the higher liquidity balances, the El Nino risk, the fact that the Fed is going to hike later, probably in July, and also the other central banks also coming in and hiking. So most of the market really didn't expect the stance change to happen. But I think, like you rightly said, this level of maybe some more level of dovish pause was what would have been expected by the market. So to that extent, I think the question is very valid. So I think right now, like you also rightly pointed out, I don't think this RBI and this governor at this point of time want to signal to the market that rate hikes are just around the corner, because of all the 3 or 4 reasons that I spoke about just now. So it's quite possible that they want to keep the flexibility with them and not really give away all the cards to the Reserve Bank. So it's quite possible that if all the expectations do actually materialize in terms of the Fed actually peaking in July and inflation actually, coming down, it doesn't take much for the central bank to also, look at changing its stance and maybe, cut later. But having said all that, we were anyway of the view, our house view was for a rate cut only in February or maybe in April. I think what has happened today kind of strengthens that belief that we can't expect a rate cut from RBI this calendar year. Okay,
so the RBI went with ICICI's thinking, huh? So it seems. Mr. Khara, what does it mean to the bank actually? Bank stocks I thought actually would fly today, but for other reasons there was a subdued end to the Nifty Bank. But basically that puts you all in a sweet spot, isn't it? Liquidity is plentiful, so you all don't have to raise deposit rates, and you are all linked to external benchmarks, so lending rate is going to be high. You're going to enjoy higher margins for a couple of quarters more, you think?
That is what we expect in the normal situation. But at the same time, we are always very mindful in terms of when it comes to the lending rates, what is something which really works in the market. So the excess liquidity also lead to a situation where the competitive pressure for the quality lending also goes up. So that also has to be kept in mind. But nevertheless, I would say that, yes, as well, I mean, if at all the real economy grows well, that is always an opportunity for lenders. And invariably, it leads to the better situation for the lenders in terms of their net interest incomes.
Okay. So actually, the governor gave the details of the return of the 2,000 rupee notes. Half of it has come back, 1.8 lakh crore, of which 80% is going to deposits. In that case, would you say that deposit rates don't look like rising for 2 quarters?
I was not expecting deposit rates to rise as it is, but yes, of course. But much of it has to be seen whether this money stays into the accounts, because when I look at my numbers at a system level, I think the deposit growths are somewhere around 10%, which is of course better than the 9% last year. Yeah. So I think there's some positive movements in terms of the deposit growth. And as far as the loan book at the system level is concerned, it is somewhere around 13-14% growth as compared to about 16%, 15-16% last year. So I think there's a bit of a recalibration in the deposit growth and also in the loan book growth. So that's how it looks like at the system level.
So even for lending rates, you don't see that much of a competition for loans. So you don't see the cost of capital rising for, say, a typical AAA company.
I don't think so, because for the well-rated corporates as it is, there's a huge competition among the lenders.
Okay. Well, I'll take a quick break, but then we have lots more questions on the state of the economy from the bankers and the economists who are with us. We are back in a jiffy.